Here again with Smart System. In our last lesson, we finished up our series on the basics of interest rates in the Federal Reserve, with a look at how the Fed goes about signaling potential changes in monetary policy to the markets. In today's lesson, we're going to start a new series on economic numbers, with a look at the role these numbers play in helping economists, the Fed and market participants such as ourselves, gauge and anticipate levels of growth and inflation in the economy. So let's get started. As we've learned in previous lessons, there are many components of the US economy which can affect overall economic growth and inflation expectations. Some of the major examples here are how many people are employed in the economy versus unemployed, how much the housing market is growing in different parts of the country, and what the rate of prices for different products in the economy, if they're seeing price increases or not. All these things are so important to the economy, and therefore to the markets. There are no shortage of economic reports, which are released to try and help people gauge how things are going with different pieces of the economy. It's important for us, as traders, to understand the major reports here, as even if we're trading off of technicals, understanding what is happening in the market from a fundamental standpoint can help establish a longer-term bias for trading. In the short term as well, an understanding of these numbers will help to assess the erratic and sometimes extreme movements which can occur after economic releases that come in off estimates. The granddaddy of all economic reports is the release of the gross domestic product number for the economy. Gross domestic product for the US or any other country is the final value of all the goods and services produced in that country. Essentially, what you get after calculating GDP by adding up the value of all goods and services produced in the economy is a measure of the size of the overall economy. It's for this reason that the market participants will watch the GDP number closely, as the rate of growth in this number, when compared to previous numbers, represents the rate of growth in the overall economy. As a side note here, GDP also allows a comparison to be made of the sizes of different economies from around the world, as well as compare their growth rates. To give you an idea of just how large the US economy is, the 2007 GDP forecast for the United States, our estimate is $13.7 trillion. This is in comparison to the next largest economy in the world, Japan, which has a GDP of under $5 trillion. So more than double the size of the next largest economy. Quarterly estimates of the GDP, gross domestic product of the United States, are released each month, with advanced estimates which are incomplete and sort of subject to further review, being released near the end of the first month, after the end of the quarter being reported. So let's say the first quarter. After the end of the first quarter in the next month, you're gonna get the advanced numbers, which is an estimate, because they don't have all the data and they haven't had time to pore over everything, etc. And that number is going to be watched closely, because that's going to be the first hint or estimates of what the growth in the economy was for the quarter. In the second month, after the end of the quarter being reported, you get the preliminary numbers, which basically means more accurate than advance, but still an estimate. And then finally, in the third month after the quarter ends, you get the final GDP number of the quarter being reported on. Traders are going to focus heavily on the growth rate, releasing the advanced number, and they're also going to look for any significant revisions made to the preliminary and advanced numbers. So when the preliminary numbers release, they're going to look for any significant revision over the advanced number. When the final numbers release, they're going to look at any significant revision over the preliminary number. And if there are significant revisions there, you can see pretty heavy market action after that, as prices adjust accordingly. While a high rate of growth in the GDP number represents a fast-growing economy, remember from previous lessons that this can be a good or a bad thing for markets, as they react to future growth prospects. If growth becomes without an increase in inflation expectations, then market participants will normally remain optimistic about future growth, and we should see markets rally as a result. If, however, a high growth rate is considered unsustainable without excessive inflation, then market participants may react negatively and drive markets down as a result of this, as they anticipate monetary policy action from the Fed to slow the economy down in order to contain inflation. As we've learned about in previous lessons, Once you begin to follow the analysis, which are differing sources, such as the Wall Street Journal and Bloomberg, put out on the release, you should have a good feel for what the market is expecting from the number, and how the market should react. If the number comes in out of line with expectations, you really just have to follow several releases there, and you sort of get into the flow of things, and sort of get a feel for what people are looking for, and then what should happen as a result of that. As a general rule of thumb here, however, most people feel that the economy can grow over the long term, without running into inflation problems, is around 3%. While the quarterly numbers can deviate up and down from this fairly significantly, it begins to cause inflationary concerns when growth stays, or as anticipated, to stay much higher than that for long periods of time. There's obviously a huge amount of data that's used to compile the GDP number, and much of this data is made available with the release. As much of this data gives traders a window into the health, all of the different areas of the economy. Heavy attention will be paid to the various components of the GDP number, as well as the top-line growth number. And this is going to be the topic of next lesson, so I hope to see you then. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.